Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode, we're talking about the outlook for the economy, the mortgage market, the commercial real estate market, and credit quality broadly, and what that means for bank performance and strategies going forward. Those topics and more were covered in detail during panel discussions at the inaugural Raymond James Home Loan Conference in Nashville. I was lucky enough to be in attendance and among the presenters, and I've asked the host of the event, John Toohig, the head of whole loan training at Ray J, to come on the show and talk about the many great takeaways from the conference. John, thanks for coming on the show.
Well, Nate, I have to say thank you to you. I'm a huge fan of you. I'm a bit of a fangirl as it comes to that. I'm a huge fan of your podcast. So to get to be invited is a real honor for me also. I know a lot of our clients love your content as well. So was glad to have you for the presentation and really thought you brought some great wisdom to the discussion. I've already heard tremendous feedback from clients on how your panel went and others. And so I'm excited to decompress after a couple of days with you on all of the discussions that went around lending and banking. And I thought it was a great time.
For sure. Definitely a great time and lots of terrific content and takeaways about what is going to happen to our space. Before we get into that, though, it probably makes sense to sort of lay out how you guys set up the event. What was the event? Who was there? What was sort of the structure of it?
Well, we put a lot of thought into it, and don't laugh. This was supposed to have happened on September of 2020. Right? So we had started the planning process in late 2019, early 2020, and we were ready to kind of go loud with it on paper, looking at the calendar kind of March, April, May of 2020. And, obviously the pandemic hit. And so this had been talked about for quite a while as we were trying to kind of pull it all together. But the goal was to kind of hit looking at a depository's balance sheet. And I'm not talking about Goldman Sachs or Bank of America. I'm talking about regionals, talking about even community depositories, maybe large size regionals, but $75 billion in assets and down. It was really kind of the folks that we were looking for. And we wanted to hit anything that might be on the balance sheet and not the bond of the day, but more in loans. So mortgages were a heavy piece. Automobile lending was a heavy piece. Commercial real estate, obviously one of the hot topics in lending right now, and what's going to happen there was a heavy piece. Fintech lending's been hot. So we had some real specialists there in kind of the consumer unsecured space. Credit cards, also a real focus. And so that's kind of the asset side of the conversation. And then we brought in a few folks like yourself, Bill Salmon, more on our investment banking side, on looking at it more how an investor might look at your balance sheet and what might make you attractive candidate for future investment or for M&A. So it was a hope. The takeaway from a lot of our customers was good information about the assets they own, good information about what they may need to do to position themselves to go on offense in 24, and a thoughtful approach to managing certain assets that might be a problem for them, maybe say in the commercial real estate sector or maybe in the lower credit unsecured consumer sector.
Sure, and kick things off with kind of a level setting of where the economic landscape was. Great presentation from Chris Doritis, Deputy Chief Economist at Moody's Analytics. And I felt like he kind of put it as, recession or no recession, and then dove into it. What was your takeaway there? Do you think that he sees one coming? The other piece that really stuck out to me was sort of the potential threats to the downside he talked about. But what was your sort of takeaway from Chris?
Chris and I formed a really good relationship over the pandemic. And if you can remember how we went almost everything webinar because we couldn't do things in person. And so we formed a really nice, real open dialogue with him and Mark Zandi as well. Chris is the Deputy Chief Economist. Mark is the head guy. And they're very easy to talk to, first of all. They're very conversational in their approach. They don't just get up there and read a lot of numbers to you. They can really kind of communicate the guts of it. And I got to give both Chris and Mark a little bit of credit in that they've been contrarians throughout most of this. They have said that the economy is going to hold up. It's going to be better than you expected. The consumer is going to remain strong. They've got a host of savings. Their bank accounts are full and flush. And, we're a consumer-driven economy and a consumer spending-driven economy. And so long as the consumer keeps spending, everything's going to be rosy. So when Chris got up on stage and he started mentioning what he has coined, and sometimes people give Mark the credit for it, but Chris was the one that mentioned maybe a slow session, not a recession, seeing a gradual slowing of spending, a gradual, weakening of wage growth, a gradual weakening of employment, but not a sledgehammer, and maybe not even a soft landing, maybe a no landing, not a hard landing, really buoyed by whatever number you want to use, the $5 trillion dumped on us or the $10 trillion worth of different programs that are out there that might buoy the economy. So Moody's has been maybe a little bit more rose-colored glasses, a little more glass half full in their outlook, as opposed to those that everybody's out there that's the doomsayer that's saying that the recession, the most forecasted recession in ever, is coming, and it's coming like right now. All of those folks that were making that statement that we would be in a recession in June, July, August, September of 23 have been just proved wrong, and that the consumers remained resilient. And we may not see something until this time next year for the first rate cut. So I think, if anything, from Chris, it was a more optimistic look. I think it was a thoughtful look at some of the big pieces of data that are wages, that are jobs, that are consumer spending, that are slowing but not plummeting. I think that would be my takeaway from his chat.
Yeah, and I talked to him beforehand, and we were having a similar conversation about what he was thinking about, and he pointed out, isn't it remarkable that you have the bank runs we did in March, and the second, third, fourth largest failure ever, and we're just sort of kind of trucking along. You never would have predicted that to be the case. Market certainly wasn't there. It really does show how much momentum I feel like the consumer had, or maybe it was because of stimulus and a lot of reasons that you said, but it really is pretty remarkable when you think about that.
And I hope this is okay that I can give them a plug, but both Mark Zandi and Chris Terides have a podcast on Moody's Talks called Inside Economics. I've visited it before. It has some good conversations, a lot like your content, really, to be honest. It's about banking, about lending, and they talk about things that we're really chatting about here.
And one of the other things he mentioned that I thought was interesting too, and I brought this up when I spoke, is when he was taking apart the inflation pieces and looking at what's driving it. Service piece has been kind of sticky, and he pointed out on sort of one of his threats to the downside, but he saw it as small and manageable, and I got a question from the audience, was student loan debt repayments coming back on for, I think he said 24 million Americans at around 350 a month, and that's a headwind. But, I kind of made the case, and I said this to him, and he said, possibly that might help do some of the Fed's work for it. So kind of keeps us, yes, higher for longer, possibly, but not much higher than where we are today.
Thank God.
Right.
Right.
And I think everybody in that room wants it that way for sure.
His three takeaways say, Larry, I presented a half glass full kind of approach, and I get it. Not half the room is probably looking for the half glass empty. And his thought was, okay, consumers are anxious. I keep reading about this recession, and is it a self-fulfilling prophecy that if we talk about it enough, eventually, we'll tighten up and it'll happen. But if the consumer does falter, that was one of his things. He said, you got to focus on that. You got to watch the consumer. If that spending does truly slow, you got a problem, and then two, wages and jobs, which are somewhat hand in hand, is that if layoffs come, they come in droves. They don't often come in drips and drabs. And so if you see, massive layoffs start to happen, or a significant move in the unemployment rate, and I think his forecast was a move sometime late next year, even at a 25, around the 4.25%, 4.5%, which is not that big. Is actually, some might even call that full employment, unlike where we're just at historic full employment right now, is where you should, maybe start to focus on if you're kind of looking for, if you are a naysayer and you're wanting to find some bad, those are places you might want to start to monitor.
Mm-hmm. Well, let's pivot to the next session, which was really focused on mortgage. And you had a great panel there, representatives from the NBA, Fannie and Freddie, and your own Steve Moss, great bank analyst who I've known a long time. And I thought the outlook there was pretty darn positive when you think about from a credit standpoint, and that the outlook for housing was very strong, and that housing remains resilient because of lack of supply. But then on the flip side, it kind of depends on how you're looking at it. You guys quite rightly spent a lot of time talking about, okay, what does it look like for the origination environment? The amount of new paper that could sort of hit the market. What was the outlook really for both? Do you agree, one, that it was pretty positive in terms of resiliency, but then on the flip side that maybe we need rates to come down to really see more origination activity?
Well, when we got originators in the room, so you got to know who your audience is, right? To your point, credit, the theme on credit was that it's probably as good as it's ever been. Mortgage was the villain in 2008. It's what brought everything down. And we never really got back to the building and the oversupply of housing and the too many units and getting out of balance from supply and demand, which kind of led us into the property value crunch and then ultimately the subprime crisis and then brought us all down to our knees. So the builders never came back. And as such, if you look at the mortgage market, it probably is clean as it's ever been from an underwriting standpoint. There's just not really much to talk about. If you look at all the different consumer lending products out there and autos and unsecured and credit cards and personal loans and mortgages, mortgage seems to be the winner from a delinquency and a charge-off standpoint right now. There's tremendous equity in housing. And so I think most said on the credit side, bulletproof's too strong of a word, but it's a leader, if you will, in safety from a true raw credit default standpoint. Again, back to my comment that there's a bunch of folks out there in the room that are loan officers and originators, and they want to hear that we're getting back to a $4 trillion a year mortgage origination market. And, I thought Hamilton Fout from Fannie Mae did a good job about Len Kiefer from Freddie Mac, who's a must follow on LinkedIn, by the way, Mike Fratantoni from the Mortgage Bankers Association, all fairly lockstep in their forecast of somewhere around $1.5 trillion to $1.7 trillion in originations for the foreseeable future, largely dominated by purchase money. Refi is flat on its face, dead right now. And, trying to remember that over the last 20 years, a $2 trillion origination average is the norm. 2 years of, 2020 and 2021 of, $3 to $4 trillion in originations was an aberration of policy and ultra low rates and the quick return of refis and almost refining your originations from the year before. So it's interesting to see, those folks in the origination market try to find other products. We talked about non-QM lending, bank statement asset depletion lending. You can argue that's a step down in credit, but it's very equity-based lending. The loan to values on those loans are in the 50% context, and the FICOs are pretty good. You just don't have perfect clarity into what their cash flows, their income is. HELOCs have been really a shining star in mortgage kind of orbiting market, and there's a lot of trapped equity in the housing market. How can we get that equity out? You don't necessarily want to do a cash out refi at 7% today. You'd rather just take a smaller balance HELOC loan. So a lot of talks about how there are other products out there absent just 30-year fixed rates at 7.5% today that might drive product outside of the mortgage market.
And I definitely talked with a number of bankers who were having that discussion, trying to figure out another way to sort of have growth. I was almost steering them away, should you even be kind of growing right now. But that was a conversation that came up a number of different times. And the place that they were sure that they didn't want to load the boat up anymore was more in CRE, where they said that there was lots of opportunity there. That was the next panel. And I thought the panel did an awesome job of really giving a big overview of all the different things that are in the CRE market, and of course focused a lot on office. You had a couple of your colleagues with Raymond James on the panel, the MBA represented, Victor from Manulife, the buy side represented there. To me, one of the things that I think stuck out most was that they thought this was going to take a while to play out. There's been plenty written on this topic, plenty talk about fears in office, and we've even seen some loss content pop up. We just had another bank yesterday write something off at 50 cents on the dollar, Notion first. What stuck out to you? I mean, did the timing piece, did you think that was pretty interesting, that they were talking about that this isn't just going to be this binary event, that suddenly we're just going to see this show up?
I think, again, the naysayers, those with that half glass full kind of approach. They want to see the world burn, right? And they see fresh tinder in the commercial real estate where they're ready to see that just explosion happen. And could it be a 2008 mortgage-like event, but applied to the commercial real estate world? A couple things we learned from 2008 in the housing space was that, modifications, extensions, working actively with borrowers to keep them in the property, and yes, limp through, no, not get all your cash flows, yes, take modest losses. There's wisdom there. Now you're going to have your jingle mail when someone just hands you the keys because they know they're never going to make their money back on the property because you made a dumb loan. But we felt that in the pandemic as well, right? When if you can rewind your brain to June of 2020 when we all thought it was coming to an end, and the agencies were quick to say, NCUA, FDIC, OCC were quick to say, give grace, be patient, work with your borrowers, listen, stay in touch, work with them. Here even recently have those three regulators released another newsletter saying that, again, give grace, listen, work with your borrowers. We're not going to come with the hammer on you. So to your point, Nate, I think what we've seen so far have been the strategic sellers, those that are trying to make their first loss their best loss and move on and clean the balance sheet up and communicate out to the market that I don't have an office exposure. That's a problem anymore. I fixed that issue. And yes, it hurt. It was 50 cents on the dollar, but I'm ready. I'm moving forward and I can play offense, and I'm off that. Extend and pretend, I think is the word of the day on that. A lot of, it's real though, right? There's a lot of maturity defaults. We talked a lot about the debt wall that's coming, the number of loans that are either in CMBS that are coming due or in whole loan form that are coming due. And those loans can't make the payment to the step up today at a current cap rate or a current debt yield. But they can keep paying yesterday's rate. And so they will continue to cash flow. That's the good news. But the cash flow has not stopped. It's just not the cash flow today at where a new origination, current market cap rate might need to be. And so the question, I think, is how long are we going to be higher for longer? And if we are higher for longer, for years, as opposed to, we're almost to the end of this and cuts are coming, over time, you'll start to feel the strategic sellers having been the winner, but eventually those that are forced to sell, that gun gets ever closer to their head. And we just haven't seen credit truly break yet. That's, I think, the part that everybody was trying to figure out is when might that happen? There's a lot of money on the sidelines. Victor Kalanog, I thought, from Manulife did a great job, and he formerly from Moody's Analytics, and he was quick to quib with, I got show me an offer. I got money. I'm ready to spend, but he's going to be opportunistic in his purchases, and the gap on the bid versus the ask, pretty much any asset, whether it be office, which is the obvious target, but even multifamily, even industrial, even retail, even hospitality, even self-storage. There's a pretty wide gap between where a seller owns it and might be willing to sell it, as opposed to where a buyer opportunistically feels that they want the right yield to make the math work. So that, I think my biggest takeaway from commercial was that we still have we're frozen, I think is the right feel for it, that we're not making really truly any progress to close that gap. There are the strategic sellers, but it's not en masse. I think it's all being discussed at the board level. Everybody would love to sell if they could get something close to par or maybe in the high 90s kind of dollar price, where the bid is maybe more in the 70s and 80s, depending upon the asset and the location. And that gap's got to close, I think, before you see anything really shake loose in the commercial real estate market, so long as credit doesn't break.
Right, and that was my takeaway as well. And I love that you went back to '08 in particular because it is the 15th year anniversary of Lehman's fall today, the day we are recording this.
I didn't know that. Thank you for sharing that little bit of nugget of knowledge. That's fantastic.
But I happen to agree with you, and my takeaway from them was that maybe what drives that gap closer, it is just time between one, getting more comfort over where the economy is, two, getting more comfort over what loss content looks like, and three, that maturity wall getting closer.
Yeah, Nate, one of the other things we didn't mention was the lack of valuations. Since nothing's trading, you see all of the data coming out, which implies cap rates are going up. But when you have, 70% fewer transactions in the commercial real estate market, that data is one, thin, and two, late. It's a lagging indicator right now. Until we get back to a more normal, unfrozen market, LTVs, they don't really mean anything. It's all about cash flow right now in the market. Can it support the debt at whatever level you're trying to have it support it? And if so, that I think is going to be something that comes into the data in Q3, Q4, into 24, into 25. And I think we'll find right now that most of that data is wrong. And not because it's wrong because someone's trying to misrepresent it, it's just because there's not enough of it. It's the absence of the valuations and the trading that's kind of creating that gap in the bid and the ask spread.
Right. And Victor even talked about, too, you mentioned quite rightly, we're seeing strategic sellers, but he talked about how a lot of what we've seen in terms of just even markdowns, write-downs, and charge-offs are from some of the bigger guys who've got 3 or 4 other businesses, outside of being lenders. I don't mean outside of commercial real estate lending, so for them, it's a much smaller piece of their book. So it's not necessarily representative of what everybody else can do and will do, one. And two, they also own different kind of properties. It's not the same. That might have been you who made that point.
Right.
We're not talking about loans to doctor's offices and dentists in smaller markets. In a lot of cases, we're talking about big Class A office properties that we've seen move thus far. We haven't gotten down to what most community banks own.
Well, and they also wanted to point out very rightly, and it's been publicized 1,000 times, that community banks do not own 70 to 80% of this risk. It's just not true. It's been publicized even as broadly in the Wall Street Journal here recently. When you look at that breakdown, that number is much, much lower, maybe in the 20 to 25% context. And to your point, it is more everyday America. It's not the $80 million San Francisco office complex. It's the $1 to $10 million loan. It's not the Empire State Building, right? So it's a different kind of bucket for community and regionals, which is not to say that does not have some risk associated with it. It is relationship driven often. And so, just as we think about what we read, to be a true student of the commercial real estate market, to know there are winners and losers, location, as they say in real estate is a really important, and cash flow. That is what matters today in commercial real estate.
Certainly. We also talked plenty about card and fintech and auto, but I want to jump to Bill Salmon's presentation, which I thought was really, really interesting.
He's one of our best speakers. He's really strong. He's so good.
And the thing that stuck out to me is how he started off and talking about where the investment community is and how investors are skeptical and how it feels like nothing is happening. There's money on the sidelines being waiting. There was more generalists at your bank conference a couple weeks ago, he said, than they've ever seen, but they're waiting. And it feels like nothing is happening. But then he said, when you go into a bank boardroom, it's chaos, which really, really stuck out to me. And what was he talking about there? Just why do you think he described it as chaos in terms of what's going on at bank boards?
And for the listeners who don't know, his business, he makes a market in small bank stock, thinly traded institutions that are looking for liquidity in periods of volatility, and it's not Bank of America per se, right? And so he's often described it, as I've listened to his calls with our customers, it's kind of like the duck on the pond, right? From the top down, the duck looks, steady and not much going on. And when you look under the water, he's paddling like mad, right? Trying to keep things going and stay above water. And we're feeling that too in our calls and fixed income as we're analyzing portfolios. Is not a lot of people wanting to do anything because they don't like the execution or they don't like the math, but there's a lot of people wanting to figure out, how could I go on offense? One of his big drivers, one of his big kind of talking points was if you can position your balance sheet today so that you could go on offense, so that when an event happens, if there's, some opportunity that comes to you from the market and it's a good opportunity, it's cheap, that you have the ability to act because you've positioned your balance sheet right. But right now, everybody feels stuck. They can't move. They've got a lot of underwater loans. They've got a lot of underwater bonds. They're starting to feel funding pressures and margin compression, and everything goes along with climbing and higher for longer. How can they position themselves today? Whether that is through M&A, which has obviously had a pretty rough go of it in the last 12 months and is, almost at historic lows. But if they could identify a target and they can make the math work on how they could use that influx of cash to create confidence and drive the story forward and get past some of those things that are just kind of clinging to them and get out of being stuck, I think was kind of the gist of his conversation.
Agreed. And I'm looking back at my notes. One of the things that stuck out to me is him saying the opportunity cost of not taking action is going to be huge. And that he feels that boards are starting to recognize that. You mentioned underwater bond portfolios. He said there's lots of people talking about a restructuring trade. There's obviously a capital hit that comes with that. But I was encouraged to hear him say that he had recently seen, I think it was 4 or 5 PE funds raised pockets of $400 to $500 million aimed at basically helping facilitate that trade. And I even spoke with him afterward, kind of trades like what we saw at Bank California PacWest.
I would say PacWest was the one that came to mind as well. Yeah. Yep. And I think that's what the market is going to need creative bankers like that say, hey, let me give you $400 million. We're going to sell X trillion dollars of deeply discounted underwater loans. And that's going to free up that anchor on the asset side of the conversation that's going to drag on earnings. And we just recognize it's a loser. It probably doesn't have a credit problem to it, particularly if it's mortgage, which is a conversation around PacWest and others. But it's a below market coupon, and we know that's a problem. The good news is it's going to perform. The bad news is just, can we price it right to get to the yield that the current investor is going to look at? So recapitalizing and taking advantage of an opportunity and moving forward and presenting to investors that now I'm past that issue and I'm ready to go forward into this new market that we find ourselves in.
For sure. And he also mentioned how he was more encouraged after coming out of your bank conference than he'd been in a long time. He gave the caveat of, I go home and cry every night because there's no activity. but I thought that was very interesting, though, that money is forming right there and that it could position banks to first loss, best loss, and be able to go on the offensive, because it does feel like to me, and he kind of rhymed with what I put out there, that earnings are going to be challenged and next year is going to be a little bit tougher, but there's a disconnect between where the market is, which is down 25% versus earnings being down about 10%. So if you're ahead of this and you're ready to go, there's a big opportunity on the other side of this.
That's what the market is telling us, is that we're not done yet, right? And there's something out there that's going to cause. But if you can be in a position to play offense, I actually scheduled you two back to back for that reason. I thought you two might play very well off each other. Your message, which I thought was wonderful, and kind of the totality and the look at the liquidity of the banking sector compared to, so that looking at it maybe from the banker talking out and his conversation to us looking at it from the investor talking in. Your presentations, although y'all didn't talk beforehand, I thought rhymed with one another. I think it could have been a very interesting panel to have you and him kind of riffing off each other. I think that would have been an interesting discussion. Next time, hey, that's why we'll figure out what round 2 looks like.
Well, and the one other thing he said, too, that I think sort of feeds into transaction activity that stuck out to me, it wasn't so surprising, but that the evolving regulatory response, that there is a lot of concern of what is coming.
That's one of the unknowns. Yeah, that's right.
And it's something that we've heard, too, from policy experts, that the regulators want to make sure that they don't have March again. And to me, if that doesn't mean that everybody has a problem, that means I want to have my house in order for sure. But it also might mean that if it is a little bit tough out there right now, as we know, and this isn't necessarily going to get any more fun real soon unless I take some real action, then I'm probably more encouraged to do something with somebody else and look to partner with somebody. because I just don't want to deal with it.
That was if there was a negative takeaway from his presentation, and one of the reasons why investors might be on pause, one was, have we gotten through the credit crunch yet? I think that's an open question for those that are more on the naysayer side. But two was regulation. Do you have to, if you're a $100 billion institution or higher, do you have to raise 25% more capital right now? How's that look? What's that regulation kind of come out to? So, there's not to say there aren't a few speed bumps along the road that are out there that I think haven't completely played out. Fed policy as well is obviously one of the things that we've talked about really throughout every panel on, are we done raising rates? Is there one more hike to come? When might that first cut be, so that kind of the roadmap is fully formed? But Bill would tell you that he's bullish on the market. I think he said that several times in his presentation. He is more of a half glass full kind of approach to this.
And ultimately, in closing, I felt like that was the top to bottom takeaway for me.
Mm-hmm.
Whatever asset class we were talking about or whatever the topic was, nobody was saying there's not pain. Nobody was saying that there isn't there. But think about it relative to where we are, whether that was the expectation we're going to have, this highly anticipated recession, we're going to have some sort of downturn in commercial real estate, whether we've got underwater loans because of where the yields are. Yeah, sure, right? But it's better than a lot of what people are assuming.
In January, we weren't having this conversation. In January, we were talking about the coming calamity that was just right around the corner, that the recession is here. We just hadn't felt it yet, but it's going to be one of those things. The latter part of yesterday, towards the end, where we started a little bit more on the consumer side, the fintech side, the credit card side, there was a little more negativity. The younger end of credit, with student loan repayments coming back on, there's some worry there. The lower end of income, if inflation is persistent, that lower credit and younger credit card buyers, owners might be more impacted. Same thing with autos. Maybe on the auto side of the conversation, younger borrowers, lower credit borrowers might start to feel the pinch on consumer. I don't remember which speaker it was. It might have been Chris. Might have been KBRA that Eric or Brian from KBRA that mentioned that, $300 average payment is going to come back online here soon. And that's going to eat into consumer spending. And that's going to slow down some of the talk track. But it was resoundingly positive, I think, with maybe the exception of a couple of spots in the lower end of credit on fintech and on auto and card.
Well, I'll take positive. That's what I'll stick with, and yeah, as well as the idea of let's work on playing offense and moving forward.
I think that was the right takeaway from me as well, as we get in towards the end of the year, and a lot of times people do clean up their balance sheet before year end. We probably expect to see more of those strategic sellers come to market this year. And I don't know that we see any of the forced sellers come to market this year. And so I'm sure those conversations, kind of like we talked about it a moment ago, that the board is kind of crazy and there's a lot of conversations talking through Bill. I think those conversations are being had if they can find the right asset, if they can find the right price, that they're willing to move it so they can carry the narrative into 24 that they've cleaned things up and they're ready to move forward.
Well, fantastic. I think it's a great place for us to leave it. John, thank you so much.
Really, thank you. It was great to meet you in person. I know we've talked so many times during the pandemic, but it was good to finally put a face to the voice. And thank you so much for the invitation today. I really enjoyed the time.
My pleasure.